Hello, welcome once again. This is Seewing Yi, and welcome to another video episode of real estate investing. And today we're going to talk about the most current Redfin report, dated September 20th, as a matter of fact. So before I begin, I would like to ask that if you receive value on this short video, please click the like button and subscribe to my channel so you can receive daily, weekly, relevant real estate information. So as a homeowner or as a real estate investor, you can make informed decisions about your financial decisions. And with that in mind, let's share my screen. And here is the title to the Redfin report. 85% of homeowners with mortgages have a rate far below today's level, a factor prompting many to stay put. All right, so it goes on to say some Americans are hesitant to sell their homes as mortgage rates soar because they have a low interest rate locked in. That is contributing to a nearly minus 20% slump in new listings. Roughly 6 of every 7, which is 85% of US homeowners, have mortgages that have a rate far below today's rate of 6%. And it goes on to say that the high share of homeowners who feel locked into their low mortgage rate is contributing to a steep decline in the number of homes hitting the market. As you can see, the new listings lately have slumped 19% year over year, 4 weeks ending September 11th, the largest drop since May of 2020 at the beginning of the pandemic. So some homeowners are opting to rent their properties out instead of selling to cash in on the rising rents. See, the benefits of owning a home, whether you own a rental home or own a primary home, is that because the rental market is so hot right now. In fact, right now it is an epic historic renters nation, as many people throughout the U.S. are unable to buy a home for various reasons, and they are opting to enter the rental pool. So homeowners, there's no reason for homeowners there's no incentive, and there's very little motivation for primary homeowners to sell their homes. Even they're under a little bit of stress, whether they lost their job or whatever. If they cannot even pay the mortgage, they can always rent their home, even like one room or room by room basis, having like 2 or 3 tenants occupying one room, or having a family to rent their homes long term for a very, very high rent. So yeah, it's very, very difficult to prompt someone to sell their houses because they have so much. Most homeowners have so much equity in their homes due to the pandemic real estate boom of 2020. I mean, 2020 to 2022. It's 2020. The plunge in new listings is hindering growth in housing supply, which is keeping home prices relatively high, even though the market is slowing down, said Redfin Deputy Chief Economist Taylor Marr. All right, so what he's trying to say is that the supply of homes are still below the healthy level, and the demand, although has subsided greatly in the past few months due to the rising interest rate, still fair demand of homes, still giving the homeowners at the market like still a seller's market, very much a still seller's market. The Redfin reporting recently that there are currently around 2.8 months supply of inventory. This means still a very record low supply of inventory and still fairly high demand. So therefore, 2% is way, way below 4 to 6 months of inventory, which will potentially create a balance healthy market. So we are a long ways, I believe. The market have to sell 300% more homes in order to reach 4 to 6 months of inventory. And in my opinion, that's not going to happen anytime soon. I'll say it again. The 2.8 months supply of home nationwide right now is way, way below what's required in order to have a balanced market of 4 to 6 months. Again, based on this article, we are seeing partly because we're moving towards a back last quarter of 2022. Most people doing is a seasonality thing, meaning on typical the last few months of each year, there's always has been a low real estate transaction. Therefore, the supply of homes coming to the market for the remainder of this year, the next 4 months or so, the next 3.5 months will be low or will continue to trend downward. So, and then of course, the beginning of next year, springtime 2023, hopefully there's a higher demand for housing activity, and hopefully if the interest rate, hovers are below 6%, maybe we'll see some more activities and some more demand coming from the buyer's side, in my opinion. So let me see, and then of course, as you can see the chart, the current approximately 6% mortgage interest rate is as of September 15, 2022, has been the highest since 2008, which is 6.04. Some of you know, some of you does not care to, as a reminder, don't want to be reminded that 2008 was the height of the housing crash, which is not likely to happen today because everything is completely reversed. So I'm not going to get into why there will not be a crash this time. That's another part of my other video. As you know, the historical low rate of interest rate in 2.61% 30-year fixed rate mortgage. This is mind-boggling. Occur January 7th of 2021. So the people that purchase primary homes and investment homes during this time frame, they have made a massive wealth killing machine during this historic 2-year pandemic real estate boom, which in my opinion, we will never see it again in our lifetime. All right, and then as we conclude in this particular article and the video, the good news is that people who already own homes have locked in relatively low mortgage rates, said Mark, the deputy chief economist of Redfin. The bad news is that the homeownership is moving further outreach for other folks as rising rates, elevated home prices, and the persistent housing shortage make buying a house more expensive. And as my yellow highlighting states, many homeowners have built hundreds of thousands of dollars worth of home equity during the pandemic, thanks to skyrocketing home prices. For some, that means moving and taking a higher interest rate is not a huge deal, especially when they're moving to a lower cost, more affordable market in other part of the country. But that the prospect of cashing out big right now from the home equity is starting to wane, is not as motivating as price growth slows and home buyers demand dries up. Let me give you an example, because I've been a real estate investor for more than 30 years, and I've been guiding and assisting thousands of out-of-state real estate investors to buy in the affordable markets for turnkey cash flow properties. Let me give you an example as to go over the aspect right here. Many homeowners during the pandemic, from around the summer of 2020 until the early part of this year, 2022, many homeowners have achieved 40, 50, 60, 70, 80%, even 100% equity growth, 100% equity growth during the 2 years, depending what market, of course. Let me give you an example. many of our investors, we guided right before the pandemic. Many of our investors purchased a house in Austin, Texas, at the height of the boom at the summer of 2020. They bought a home in Austin, new construction for $250,000 or $300,000, and they put 20% down payment, which is like $50,000 to $60,000 out of pocket. And some of the homes they purchased in and around Austin in the past 2 years have increased 60%, even 100%. So the best case scenario, the $250K home or the $300,000 home increased in value to $600,000 in a mere 2 years. I will further point out that several of my investors have purchased 4 of these $250,000 to $300,000 investment home in Austin market 2 years ago, and their homes have doubled in value from $300,000 to $600,000 per house that they purchased. So let's do the math. They increased by almost $300,000 in equity per house. They bought 4, so $300,000 equity gain in 2 years multiplied by 4 investment homes they bought equals what? 4 times 3 is $1.2 million. They have made equity of $1.2 million with only a down payment of each home of approximately $60,000. So $60,000 multiplied by 4 purchases, around $250,000 down payment to spread across 4 rental properties that they purchased at 20% down payment, and they made 1.2 million. So 1.2 million minus their $250,000 of their down payment total. So I think they have net almost $1 million in equity. So they become a millionaire just by putting $250,000 to finance 4 rental properties at $300,000 purchase each during that time, and they pocketed net on paper around $1 million net equity gain. The thing is, right, it is on paper, right? Because real estate investors are investing for the long term. I do not believe, and they should not sell the property, right? If you do not sell, you're not going to gain anything. So they can continue to hold this property. Guess what? At the time they purchased the property 2 years ago at $300,000, they were already renting. Each of the houses are rented at that time 2 years ago for $2,000 monthly rent. So they're getting positive cash flow as it is. Now, because of the skyrocketing of rents that are occurring in many areas of the country, skyrocketing 20, 30, 40% rental increases, because most home buyers cannot afford to buy a home these days. So they are entering the rental pool. They are entering the rental market. So that $2,000 a monthly rent 2 years ago, that our investors cash flow at 20% down to purchase a $300,000 property each. The rent has skyrocketed from $2,000 to approximately $2,300 to even $2,500 today as we speak. So this example of this real actual case of our investor, one investor purchased 4 properties with a total out of pocket of approximately $250,000 on paper. They make $1.3 million gross profit. If you minus the down payment, they'll make $1 million net. But they're not going to sell, of course, because they're going to buy a home for the long term, 10 years or more, buy in whole, so they can collect monthly positive cash flow from those renters. They'll be glad to pay their rent because they are renting for the time being or foreseeable future. So the investors are getting cash flow income. Skyrocketing rents will continue to happen for a short while longer. And they're getting their renter to pay down their 30-year fixed rate mortgage, what they purchased as an investor 2 years ago at 3.5% interest rate. Isn't that amazing? And then, so the renter is paying down the debt systematically on the behalf of the owner, the landlord. And then, assuming the equity appreciation, maybe not this year, maybe a single-digit appreciation or predicted by many experts, let's say 3 to 5% appreciation, short term in the next few years due to the correction of the real estate markets. So the homeowner on this 4 properties is getting equity growth, and in addition, with inflation being so high, probably a double-digit unofficially inflation. As long as inflation continue to go to be high, the rental rate increases should pattern after they should be increasing as well over time. And then, of course, so real estate investor who have the wherewithal and the ability and the courage and the motivation to buy rental properties in great rising market, not only in Austin, could be Boise, Idaho, could be Phoenix, Arizona, could be Tampa, Florida, could be Raleigh, North Carolina. These are the trophy markets that has achieved massive amount of appreciation in the past 2 years. Now, who knows, what are the actual price reductions going on, at least short term, on some of these houses. But to be seen, it remains to be seen. As long as you don't sell, you're not going to realize any loss or gain. So, I'm not just talking about real estate investors. You as a primary homeowner, right now, there are some price declines in certain markets, especially high price markets in California and New York State and Chicago and what have you. But in the affordable markets, in like a south and southeast, the prices should be very, very stable moving forward. So I know I deviated a little bit into the investment side of the point. As a homeowner, again, if you locked in at your rate, great. Just wait out wait out the correction as we're going on with all the scary headlines and everything else. But at the end of the day, my takeaway is invest for the long term. For homeowners, stay put. Even if you are first-time home buyers or want to buy homes these days, as long as you can afford it, as long as you can afford the 6% mortgage, and you like the area that you want to live in personally, you need to buy for the long term. Don't flip nothing at the houses, nothing like that. If you have a 7 to 10 year buy and hold strategy as a primary homeowner or as a real estate investor, you can ride out this storm, if you will. All right. So hopefully this helps. So the takeaway is there's a winners and losers. I hate to say the word losers. The winners are people who purchase during the past 2 years before the beginning of this year, and you guys are took advantage of a historical low interest rate, almost free money, and skyrocketing appreciation, etc. But anyway, that's all I have to say, and hopefully if you receive a lot of value from this video, please again click the thumbs up to help with my YouTube channel, and also subscribe to my channel so you will continue to receive weekly, sometimes daily real estate real-time information that are very, very relevant to your situation, hopefully, so you can make an informed decision as a potential home buyer, or as an existing principal home buyer, and as a real estate investor to look into different markets to buy properties and so forth and so on. Okay, I think that's all I have to say. Thank you so much for listening, and I will see you on another video very shortly. So keep tab on what I'm presenting for the foreseeable future. Thank you for attending to the Seewing. Have a nice day. Goodbye.